Hello and welcome to the European Union Pavilion side event on mobilizing climate nature finance in the international financial architecture. My name is Nina Siga and I am the director of the Center for Sustainable Finance at the University of Cambridge Institute for Sustainability Leadership. It is my absolute pleasure to see all of you here. If I can have the slide deck up, please. We have a fascinating discussion today on climate nature finance in emerging markets and developing economies. University of Cambridge Institute for Sustainability Leadership is a department within the University of Cambridge, but a slightly funky one in the sense that we do education and research, but we also do some slightly more strange things for a university department, such as we convene leadership groups. And within the Center for Sustainable Finance, we convene three groups: the Banking Environment Initiative, the Investment Leaders Group, where we work with investment managers and asset owners, and ClimateWise, which is our insurance platform. And with more than 60 financial institutions that are part of our leadership groups, we work on two aims. Number one, to embed sustainability into every financial decision. And number two, to look at how we can change the financial system to better finance a sustainable economy. Today, we're going to be talking about how to drive private finance into emerging markets and developing economies to finance climate nature intersection. So if I can have the next slide, please. Effectively, once I do a little bit of an introduction on the policy briefing that we have put up and published ahead of COP28, all of you are going to be able to ask the panel quite a number of questions under the Slido link that you can see. If I can have the next slide, please. Our policy brief that we've published right before COP28 is called Everything Everywhere All at Once. How do we drive private finance towards EMTEs? We know that private finance is absolutely key to unlock $5 trillion per year of climate investments, and private sector will need to supply about 80% of the required investments. We have already seen today announcements by Larry Fink, who talked about the need to change the international financial infrastructure. And yesterday, the multilateral development banks put out a joint statement looking at committing $61 billion in 2022 for low and middle income economies. Things are also starting to move in the areas of debt relief. So, for example, UK Export Finance had agreed to start putting in clauses to pause payments in loan agreements. So things are moving, but what we actually also need to think about is all of the different types of challenges, as well as all of the different types of solutions that are available in order to drive private finance. If I can have the next slide, please. So in this policy brief, we looked at two sets of factors: the global factors as well as the country level factors. And for each of those factors, we've analyzed both the challenges that private finance has, but also the solutions that have already been proposed on the ground. If I can have the next slide, please. I'll talk you through first the global factors. Effectively, there are a number of things here. We can start talking about supporting the Bridgetown Initiative, which has been quite prominent already within the COP28. Looking at harnessing the power of special drawing rights for biodiversity finance. In terms of regulation and public support, we're looking at applying the cascade principle, developing global as well as country level net zero transition plans, thinking through debt relief. So effectively, the type of announcements that UK Export Finance has made today, but also thinking through the role of central banks in greening the financial system. We also looked at market scaffolding, of how we can develop more diverse and innovative market instruments, as well as in the area of insurance, thinking through how we look at development of multi-year underwriting policies. In addition to examining a number of global factors, we also looked at country level factors. So if I can have the next slide, please. And in terms of demand side factors, we're looking at investment climate and business environment, thinking through the IMF Green Financial Management Framework, and in terms of upstream, midstream, and downstream. So in terms of upstream, looking at the differences in market creation and infrastructure development, and amplifying the importance of collaboration across these. In terms of midstream project creation, actually thinking through the variety of environmental and social risks that exist out there and how we can improve the understanding, measurement, management, and mitigation of those risks, as well as think through which of those risks are existing and where it's risk perception playing a role. In terms of downstream financial linkages and risk perception, we can look at different business models in terms of thinking about originating and sharing as opposed to actually holding stuff on the bank's balance sheet, looking at political risks and currency risk and what private finance can do already to provide cover for those risks, expanding the use of guarantees by multilateral development banks, but also thinking about data sharing. Now, having gone through all of these factors, we also put together some immediate COP28 asks, things that could be done today. Can I have the next slide, please? And within these immediate COP28 asks, of course, is one of the very first things we've got the support for the Bridgetown initiative. From there, we're also looking at diverse financing models. So thinking through those originate and share, as well as originate and transfer models, and looking at the use of hybrid instruments, hybrid capital instruments for the multilateral development banks. The importance of collaboration really cannot be underestimated within this space. So bringing researchers, NGO experts, together with private finance, with multilateral and development banks, with governments and policy experts to build these financial structures together. But also thinking through strengthening risk management and bringing guarantees. So when we look at one of the biggest challenges that private finance faces, a lot of them have to do with particular country ratings of where it needs to be invested, and generally the increased perception of risks in these countries. So thinking through how we can use donor guarantees or multilateral development bank guarantees in that context is particularly important. And that will help us also with private sector alignment and aligning some of those very clear risk return criteria, as well as talking through political risk and country risk hedging. And we've already seen certain organizations starting to step up and starting to offer those kinds of products into the market. Of course, transparency is absolutely key. There are certain things, certain understanding, certain knowledge that multilateral development banks have that private finance doesn't currently hold. And for them, the thinking through data sharing, for example, sharing of loss histories, and enhancing the dialogue between multilateral development banks, as well as the credit rating agencies and shareholders, is absolutely important. So this is a short overview of what we've looked at in our policy briefing. But now we have an absolutely brilliant panel that will talk us through some of the questions that we've got. So if I can introduce our panel. We've got today with us Andreas Thurman, who is the environmental finance and partnership specialist at the Asian Development Bank. If I could have the next slide, please, so that you can actually see the panel as well, and the next slide. Fantastic. We will also have Tom Taylor, who is the head of climate finance at Aviva Investors. We've got Caden Macedo, who is the Sustainability Director at Natura, and we will be joined by Diana Aconcia, who's the Director for International Affairs and Climate Finance at the DG Climate Action, the European Commission. Thank you very much, all of you, for joining us here and for lending us your expertise and allowing our wonderful audience to ask you some questions. So let me start with Andreas. Andres, from your perspective at the ADB, what are the key challenges that you're seeing in mobilizing both public and private sector resources in emerging markets and developing economies for climate and nature goals? And how is ADB working to address these challenges?
Hello, good evening, and thank you very much for inviting us to participate in your panel today. And yes, Asia and the Pacific, we contribute about half of global GHG emissions. And at the same time, our region is also extremely vulnerable to climate change, with many countries highly exposed to natural hazards. So therefore, the question of how to raise more public and private finance for nature and climate is particularly important in our region. That's also why we, as ADB, have transformed into the Climate Bank for Asia and the Pacific. Our ambition is to achieve $100 billion of climate finance from 2019 to 2030. We also can see progress when we look at some figures, for example, in the energy sector. By 2023, global clean energy investments will outpace fossil fuel investments by about 1.7 to 1. Just 5 years ago, the ratio was still 1 to 1. However, the pace of transition needs to accelerate and happen in more sectors. There are many interrelated challenges to overcome to increase climate and nature finance. I want to focus on 4 challenges that I find particularly important. First, limitations to government spending. We must enable governments to spend more on climate and nature. In September, ADB just announced that we will make $100 billion additional lending available over the next decade to support our region to tackle the climate and nature crisis. We will do this by optimizing our balance sheet and through a new innovative guarantee facility in which donors can guarantee parts of our climate portfolio. So for every $1 a donor will guarantee, we will lend an additional $3 for climate and nature. With our developing member countries, we are also looking into the issue of reducing harmful subsidies to free up funds for a more sustainable development path. For those countries that are facing budget restrictions after the economic shock wave of the last few years and the COVID crisis, we are currently also looking at novel tools like debt for nature swaps that involve privately held debt. With these debt for nature swaps, we want to help countries to lower their cost of debt and improve their overall debt situation while unlocking significant funds that support nature and climate. Second, regulatory frameworks and investment environments. Countries must further improve their regulatory frameworks and investment environments. If countries establish a price for harming nature and the climate, or for services that nature provides, it will become easier to develop bankable projects and scale up financing. This may be carbon taxes, ecosystem payments, tax incentives for nature-positive investments, or in a first step, just stopping harmful subsidies. We at ADB are working on all these avenues with our member countries, both with advisory projects and with policy loans that encourage such changes in regulations and policy. Third, private sector participation. Such reforms will also help to unlock the private sector and reduce the burden on governments. Still, such reforms will not be sufficient to unlock private investments in all areas and will require time for investors to develop a better understanding of these new investment opportunities. The donor community, therefore, must support the private sector in developing nature and climate projects. We will also need concessional funds to incentivize and mobilize private sector participants until the business and revenue models are fully established. Fourth and last, just transition. At the same time, it will be very important to not endanger social cohesion by this enormous shift that has to happen within a short time frame. Countries need to ensure that the poorest members of societies, who most often already bear the strongest impact of climate change and nature loss, are not the ones who have to cover an overproportional burden of this cost. We at ADB have started to develop mechanisms to support a just transition. We piloted this work mainly in the energy sector and in Indonesia. A very simple but important example are training programs for coal miners to prepare them for a greener job market. we will have to roll out similar programs in other areas. For example, when we try to reduce overfishing and support coastal communities. Thank you very much.
Thanks, Andres. And now if I go to Tom. Tom, can you give us an idea of what role do you see for MDBs in catalyzing private sector involvement in this space? And how can these institutions catalyze a more inclusive and effective system of climate and nature finance? Tom, I can't hear you. Can you check? Can you unmute yourself?
Yeah, can you hear me now? Oh, great. Okay. Sorry, not sure quite what happened there. Anyway, thank you. Yeah, thank you so much for inviting me to join this panel. I think as Nina said, multilateral development banks do have a crucial role in making the system of finance and finance flows in particular to emerging markets and developing economies work better. At the moment, we know that those flows are significantly less than what we need. So we've got statements like the one that we saw reiterated from Nick Stern, Vera Songway, and Amar Bhattacharya's paper that was released today, talking about the role that the multilateral banks are going to play. One of the reasons that they are so crucial to this is that they have the ability, and we're seeing them agreeing to step up their ambition. There was a fantastic array of the heads of these institutions in the main plenary today, talking about their commitment to enhance their ambition here. The reason it's so crucial, particularly for private finance institutions, is that if they use their balance sheets to encourage private finance to follow in behind them and to de-risk investments, then some of the barriers that exist in the regulatory system can be overcome. So one of the problems in the emerging markets and developing economies is the vast majority of countries have sub-investment grade credit ratings, and so do the projects that are being identified. And that creates a disincentive, particularly for institutional investors like insurers and banks, under their regulatory system, because they will have to hold regulatory capital against those instruments. If the multilateral banks can use their balance sheets and use their ambition increase to bring investment up to investment grade, then the ability of private finance to follow in behind them is hugely increased, because suddenly you don't have what is actually a very punitive system in Basel and Solvency II, for example. So that's one element of this issue. But I think one thing that also needs to be recognised is, if we're talking about mobilising 5 to 7 trillion a year for the transition, and that about half of that is going to have to flow to developing economies and emerging markets, admittedly with domestic resource mobilisation as well, you're not going to do that just with multilateral development banks, however ambitious they are in terms of their balance sheet. So there also has to be means to bring in other forms of investment, including private capital investing on commercial terms. So we need to look across not just the multilateral development banks, but across the whole of the financial architecture, to make sure that we have a transition-focused, transition-oriented system. Because ultimately, the system that we're trying to create protects the stability and integrity of the financial system that is challenged if we don't solve the climate and nature crises that will undermine the way that the system currently functions. So actually, investments in emerging markets and developing economies help protect the value of developed markets investments as well. As the head of the Global Climate Fund has said, is that basically investments in emerging markets are investments everywhere, because the system is all connected, and these are systemic risks that you can't diversify away, and therefore it's crucial that we look at the impact of systemic risk as well as instrumental risk and country risk. So we need to think about the regulatory system as well as the role of the MDBs. Thanks. Back to you, Nina.
And that's an absolutely perfect connection for me, Tom, because we've got Diana with us today, who's joined us after a very busy day at Climate Finance Day at COP. Diana, thank you for joining us. Could you talk us through the European Commission's approach to co-designing innovative financial instruments that support climate action and a nature positive economy, especially in the context of EMDs?
Hi, and thank you. Good afternoon for those of you who are in the European time zone, everybody. And sorry for joining late, but I had to take the floor in another event, so I couldn't leave. But it's a pleasure to be with you and to speak about this issue that for us is very, very important, because I think today is Finance Day, but it's for me, so every day is Finance Day, I would say. I'm director in DG Clima for International Affairs and Climate Finance, and I think the need to invest in climate action is perhaps the key issue and the nut that we are maybe having some difficulties to crack. I wouldn't say doing mitigation is easy, that's absolutely not the case, but we have very clear indication of what we have to do from the science. We know that we have to scale up renewable energy, we know that you have to phase out fossil fuels, we know that you have to decarbonize the highly carbon intensive sectors. What we have not completely figured out yet is, I think, how to get finance to the sectors that matter. And it's not a question that there is not enough finance around. There is plenty of capital around the world, private capital, banks, pension funds. There's a lot of money. The problem is that the money is not necessarily going to the right sectors and to the right places. There is still too much money that goes to the wrong places. And nobody has the recipe to bring the money to the right places. So I can just say what we do in the European Union. And I think the first point that we have to take into account is the need for a stable and predictable policy framework. I think it's an essential ingredient. In the EU, we have the objectives. We have our climate neutrality target for 2050. We have the 2030 NDC with the 55% reduction target. And we have designed the policies that will help us implement the target, the policies that will take us there, and policies that are starting to gradually be implemented because we have our Fit for 55 package, which is the legislation that will take us to 2030. We have recently adopted the legislative package, and it will enter into force gradually in the coming years. And this will mean that the private sector will get even stronger signals than the signals that they're already getting now, particularly with the emission trading system, the carbon pricing, of what they have to do. And there will be an increased demand of investment in decarbonization. And so the moment that there is demand, the offer will come. And I'm sure that the investment will scale up dramatically. Now, we know that we cannot assume that everywhere in the world there is the same policy framework that we have in the European Union. In fact, the main problem that we have in developing countries is a perception of risk, which may sometimes be even higher than the risk that is really there. And therefore, the risking is absolutely crucial for us. And our flagship instrument for the European Union to the risk and to leverage public and private investment for sustainable development is the European Fund for Sustainable Development Plus, EFSD Plus, sorry for the acronym. This is a fund that is aligned with the Paris Agreement and that is a crucial part of the European Union Global Gateway strategy to mobilize 300 billion worldwide for developing countries for infrastructure and the green and digital transition. When I say the European Union, I'm talking of what we call Team Europe, which is the European Union plus the member states, plus the European development banks. But we also work with some multilaterals like the World Bank. They can also participate in it. What is the FSD Plus? It's basically a guarantee instrument of 130 billion of guarantee capacity. We made contracts with several institutions, and the guarantee instrument will help the banks that want to invest to the risk. We will assume some of the losses. It's very simple. In fact, it's a very complex construction, but this is the basic of it. And the idea is to create a more attractive risk-return profile for investors and to provide an opportunity for private investors to engage in climate resilient and low carbon projects that otherwise would have been considered too risky. I'm coming from the event that made me late for this was a meeting on adaptation. And one of the questions that I was asking the other practitioners was how much de-risking and how much technical assistance, which is also part of the EFSD Plus, how much preparation the private sector needs to finally intervene in a country which is perceived at high risk. I think that this is a point that we still have to discover, because there is a lot of project preparation and the risk in work, and in some cases it's very slow to materialize the funds for the private sector. But we trust that with the combination of the policy support, of the instrument, of the financial de-risking instrument, of the investment can come. Another innovative financial instrument that we have, it's been recently adopted, is not really an instrument, it's a standard. This is the European Green Bond Standard. It is a voluntary standard built on international best practice and principles that market players will soon be able to use to raise genuine green finance. It is based on the EU taxonomy. It is strong because it is reviewed by external reviewers, and it can be used, adopted all over the world. So we created it for Europe, but in fact, whoever wants to create a green bond standard can use it wherever to give credibility to the green bonds that are going to be issued. And from what I'm hearing here at COP28 is that green bonds are becoming more and more powerful and are raising more and more finance. In the European Union, we are pioneers of the green bond. We have the highest amount of emission, but we have seen more and more developing countries that are getting there. So we will be able to support them in this if they want to start this journey towards green bonds.
Thank you, Diana. It's actually fascinating to hear, and I'm also quite glad to hear that there's a conversation happening around private finance and adaptation, because there's an ask and an offer document going around for driving private finance towards adaptation that we've helped to co-develop. Now, Kevin, you've been sitting there so very, very patiently. Question for you, given your experience at Natura, how do you see the role of private corporations in contributing to mobilization of additional trillions for climate and nature resilience?
Hello, everyone. Greetings from Dubai. Of course, I'm not calling from Brazil, but calling also from the venue here at COP28. It's a pleasure to be participating to this special event. Thanks, Dr. Mo, to invite us. And let me try to respond to the specific question that you raised to me, Diana, saying that, and using part of the information that Nina, you share, and then Diana highlight a little bit, and Tone as well. I think that on your initial slide, Nina, you mentioned about one of the cluster was diverse finance model. And I think that is the things that Natura has been doing for a quite while. For those who don't know us, Natura & Co. is a beauty group that has headquarters in Brazil. The largest brands that we have inside the group, it's Natura and also Avon. Basically, you operate in these what we call direct sales model. And Natura, more than 20 years ago, start this development of a new business line inspired by all the discussions that we have seen over the Earth Summit in 1992. This new brand launched in the year 2000 is named Ecos or Ecos. And the main purpose of this line was to address the social and the environmental challenge that we face it and transform them into business opportunities. Of course, Tom highlighted a little bit that the development bankers will not be able to provide all the fund, and that is the important role from the private sectors that sometimes cannot do it as a philanthropy. We need to do as the development of sustainable business model. In this specific case, what we do is that we work to develop local communities, mainly in the Amazon rainforest of Brazil, trying to give all the technical support and, of course, purchasing their products, paying under the principles of the fair trade. But more than that, when you highlighted a little bit, Nina, about diverse financial model, is that how we can add more income to the baskets of the communities. And one of the things that we realize is that how we can combine the principles of the sustainable development plus the principles of the CBD, the Convention of Biological Diversity, which aims, of course, to pay access and benefit sharing based on genetic heritage or based on the traditional knowledge. And in this case of the ECOS line, we do both. In some of the cases, we do traditional knowledge, which means that based on the knowledge of those traditional communities, we were inspired to develop these new products. And in the other hand, based on the access of those biodiversity ingredients, of course, we need to pay for the local communities, and nowadays with the new regulation also on a percentage to the local government. But let's go beyond that, because we realize that also by preserving the Amazon rainforest, there is ecosystem service that those communities provide to the environment. So how we can recognize this and pay for the ecosystem service. So we do consider that whenever we create this business model, and we try, of course, to add more incomes to the baskets of the communities, we are supporting them and creating a financial mechanism to be an alternative to the deforestation. We need to realize for those local communities, they have the forest just in the surrounds. It's easier for them, and it is the first alternative for them actually to cut down the trees and sell them. So what we need to do is to create the model that we can generate more prosperity to them. Because sometimes we have this fake paradigm that those local communities doesn't want to pursue prosperity, financial prosperity. Yes, they do. Maybe the desires about the prosperities and what they are going to use, the income is going to be maybe different from those who live in the big cities and so on. So what we need to do is to create these mechanisms in order for them. And we have a very special case. It was a seed called Ukuba. It was coming from a tree that basically local communities was chopping down the trees to sell them to become a broomstick. And we realized that based on the scientific evidence and of course based on the traditional knowledge, that these seeds, they have a very benefit and very high quality property on to be used in our moisturizers. So basically with the equation that we were allowed to do it with the small communities, with the small farm holders that we have in the Amazon rainforest, we can pay them 3 times more than they were receiving just to chop down the trees. So imagine that we preserve the forest, we generate a larger income, And also, we are allowed us to generate a sustainable business model. So I think in this sense, of course, is one of the alternatives. Of course, this needs the desire and the leadership of those companies that nowadays has a sustainability embedded in their business model, but also relies under the public sector to create the right infrastructures in order to stimulate, in order to accelerate more companies like Natura to do this kind of similar job. Back to you, Nina.
Thank you very much. And we're going to try to do one more round of questions. So if I can ask everybody to be super brief while answering these, and I'll start with Diana. Diana, you've given us already some examples, but talk us through some actionable steps do you think are absolutely critical for mobilizing private finance in AMDs, and how does the European Commission plan to support these steps?
Thank you. Before answering your question, I just want to say something to Kenyan. I love your company. I am a client. I have been to Brazil again after many, many years of absence, and I was so happy that I could buy some of your products at the airport. I had been missing them for almost 20 years. So I would really like to, and I really like what you said, because forest and deforestation is not my competence. We have another part of the Commission that does it, which is DG Environment and the DG International Partnership for the funding. But I'm not going to tell you my own history, but I'm very interested in finding sustainable value chains to avoid deforestation. You probably know that we have a deforestation regulation that actually Brazil doesn't like very much for different reasons, Brazil and many others. I would be really curious to know if the solution proposed by your company can work elsewhere, because I've heard so much talk of sustainable value chains. I've seen very little success. And your company must be a success story, because it's still there after a very long time. So it must be profitable, otherwise it wouldn't be there anymore. So maybe perhaps we could be in touch after COP and have a chat. I would be delighted. So I've burnt all my time, but I really needed to say this because it's great. I really love those products, and I would advertise them for everybody. But on the initiatives in practice, I would like to give quickly 2 examples. I said before that we have a green bond standard in the European Union, but in fact we have gone also a step forward in helping developing countries to issue green bonds. We are launching another initiative which is called Global Green Bonds Initiative. It's another flagship under our Global Gateway. What we are going to do is to help partners both at sovereign, sub-sovereign and private level to mobilize capital via green bonds. And we're going to do so via a fund which is led by the European Investment Bank, which will guarantee, which will be a first buyer, and will serve as a guarantee to other buyers of the solidity of the bonds. And we will accompany it with technical assistance to the countries or to the entities that want to issue the bonds. The initiative is not completely operational, but it will be launched soon. The other example that I would like to give of international cooperation that has activated to mobilize private finance is the Just Energy Transition Partnerships, the JETPs, which were launched by the G7 countries, first with South Africa at COP26, and now we have 4 with Vietnam, Indonesia, and the most recent Senegal. And there we have governments and development banks of G7 countries that have partnered to support countries that have an ambitious decarbonization roadmap, and with the exception of Senegal, that are highly dependent on carbon. We are really helping them concretely to shut down their coal plants and the coal power plants and replace them with renewable energy. It is very challenging because you wouldn't just shut down a coal plant from today to tomorrow, but it's proving successful in mobilizing private sector and philanthropies around the development partners that have started the JP. We have had a couple of events at COP28 with Vietnam has presented a resource mobilization plan together with the Commission President. So we're very proud of the results that we obtained with them. We think it's a successful formula, but it's also a formula that will take a long time to implement because of the difficulties in changing completely the economic model of a country. So for now, we are not embarking in new ones because we need to deliver on those that we had. But we hope that soon we will be able to show more advanced state of implementation. Thank you for having abused the time to talk about my passion for the cosmetics of Natura & Co. Thanks.
And see, we have now the impact in action of a side event happening as we're speaking, so clearly. Now, going to Andreas. Andreas, I'm very keen to let the audience ask some questions. So briefly, can you talk about a specific example of where ADB had mobilized private finance resources for climate and nature again in EMDs, and what are the key factors that contributed to that success?
Sure, I would be happy to do so. And I think mainly that there's two mechanisms that I would like to share. I mean, the first one is just our business model in itself. And I think this is often overlooked in these discussions because we as an MDB, we refinance almost all our projects on the capital market by issuing bonds. And since we have a AAA rating, we also can tap into the funds from investors that, I mean, also as Tom mentioned, often are not willing or really able to finance developing countries. And then also these investors, they have an interest in specific green and blue projects. And therefore, for example, we started issuing green bonds in 2015 and blue bonds in 2019. And with these thematic bond issuances, we have already supported more than $10 billion of investments in climate and nature. And the second mechanism that I would like to share is the co-financing program of our private sector operations. So you might know, I mean, and the audience, that almost all MDBs, we usually have a sovereign arm and a private sector arm. And in our private sector arm, we have a specific program to also leverage and mobilize private investors. And so our track record over the last few years has been that for every dollar that we lend on our own balance sheet, we also mobilize $2 of other investors. And we have achieved this with direct syndications where other lenders just gain confidence by ADB being in a specific deal and also lending ourselves. But we've also achieved this through credit guarantees and blended finance, where donors give us some grant funds or concessional finance that we can then structure for a project. And as I understand, time is limited. I will only share one project, maybe where we combine both the direct syndication and blended finance. So just in March of this year, we could mobilize almost $600 million besides our own loan of $100 million for a 600 megawatt wind project here in Laos. And so this project will export electricity from Laos to Vietnam, and it has a total project cost of $1 billion. And it's the largest wind project, at least in terms of financing in the ASEAN region to date. And so we could mobilize $250 million from private commercial capital, $280 million from other investment banks. And then also we could mobilize $50 million in concessional loans and $10 million in grants. And this blended finance part was really decisive in mobilizing these other lenders, because with this concessional capital, we could actually structure something that will address the risk of curtailment. So that means when the power plant might have to reduce its electricity generation, when there's grid instability or imbalances between demand and supply. And so just this piece of blended finance in the end was possible then to achieve an investment of $1 billion. And I think that's a really strong case And yeah, but I think that was also just mentioned by the Commission about the EFSD guarantee and these instruments that will be really helpful in scaling up private finance. But back to you, Nina.
Thanks, Andreas. And now going to Tom, talking about exactly scaling up private finance. Tom, which strategies are essential for that? Tom, you're quiet again. Something's gone slightly wrong with the sound. I suspect the system doesn't like you for some reason.
I know the system clearly doesn't like me. Can you hear me now?
Yes.
Excellent. Okay. Well, I know I'm supposed to be brief, so essentially transition plans, but not just from corporates. We need transition plans, as your paper says, everything, everywhere, all at once. We need NDCs to basically be an investment roadmap for each country in terms of how are you going to deliver your NDC, where's your priorities in decarbonisation, and how can the private sector invest in it. If you have that from countries, then that's clarity to help the private sector work out which things they can and can't invest in, which things they're going to need MDB help in, which things they're going to need guarantees from developed countries to developing countries to provide the credit guarantees and the ratings that are needed. And we also need transition plans from across the regulators and supervisors, central banks, regulators, the multilateral groups like IOSCO, AIIS. We all need to know how the fact that 198 countries have signed up to Paris and how it's going to affect the way that all those mandates work. Back to you.
Fantastic. I now have absolutely no choice but what to ask even. And luckily, we were going to talk to you about the impact of supply chain dynamics anyway. And given Diana's interest, that works beautifully. So talk us through that in relation to the global financial system reform.
Yeah, I do consider that it's one of the challenge because, of course, if you connect the agenda between climate and nature, most of the multinationals, they will have the majority of their emissions and the majority of the impact related to the supplier chains, which means that without engaging with their suppliers, it's going to be impossible to deliver their commitment, which is good because in the end, of course, they might stimulate it and they created the demand, of course, for those suppliers. In some of the cases, we are talking about small and medium companies, not, of course, big companies. And we need to create, of course, the incentives, but of course, we need also to join forces. In most of the cases, it's a matter also to have a common solutions across the sectors or even a common solution inside the own sector in order, of course, to create a standard, in order to create scalability about some of the solutions. One of the action, very briefly, that we do inside Natura is that in some of the cases, we offer the conditions in order to create a better feasibility for the suppliers to implement some of the solutions that will generate a raw ingredient or a packaging materials with a lower carbon footprint. Back to you, Nina.
Wonderful. And you guys are brief as well. Fantastic. And that leaves us with a little bit of time to actually take some of the questions from the audience. I'm going to ask two, and then you can pick which one you want to answer. There's one talking about cross-sector collaboration and how we can drive that collaboration between governments, private sector, and NGOs to be improved to more effectively tackle the challenge. And in my mind, and through a lot of the collaborations that we've done, for example, it's being in the room at the start of the conversation rather than kind of trying to tackle people on at the end of it. And then the second one is to mobilize sufficient capital for the transition. It's necessary to pivot the overall goal of finance to favor integrated value over purely financial value. So those two, one on collaboration, how do better collaboration, and second one is integrated value versus financial value. Who would like to jump to which one? Okay, Tom, go for it.
So I'm happy to say something very briefly about the second. In the vast majority of cases, apart from perhaps hedge funds, institutional investors actually, whilst a lot of people say what they're trying to do is maximize returns, that's not actually what they're trying to do. They should be maximizing risk-adjusted returns. It's not just make as much money as possible, it's deliver the mandate you've been given and you've promised to your your customers or your beneficiaries. So for a particular risk budget in a particular asset class, what's the return that you're going to try and generate? And that question of what the risk-adjusted return is, and thinking about the systemic risks, the risks of not delivering Paris, the risks of not delivering the Kunming-Montreal framework, the risk of cascading crises that we're seeing, the fact that the NGFS base case scenario essentially is disorderly transition. So rethinking how the word risk is thought about in a much more holistic way, and knowing that all of these risks that actually have been there all along, but we're only starting to measure, are accelerants to all the risks that everyone in finance is used to measuring. So rethinking what risk-adjusted returns means.
I may cover the first question. So when we are talking about the first question, just came to my mind 3 examples very briefly. The first one of them, PPA, the purchase power agreement, even though that, of course, does not join the 3 sectors, at least, of course, it's a joint solution between companies from the private sector together, of course, with the public sector. The second example that came to my mind, it's some of the legislation that some finished goods companies needs to face about reverse logistics, about their packaging material. So here, of course, we join forces with the 3 sectors. Basically, of course, public sector setting what is going to be the targets and, of course, creating the infrastructures. And then you have the private sector trying to create the solutions and the agreements. And normally, the third sector is the one that is going to be the enabler to make the implementation of the solutions. And finally, that just came to me also, it's when we're talking about the economy of the forest. Also, we have those 3 actors playing at the same field, each one of them making their own contributions, but of course, it's a complementary actions between them.
Andreas, you wanted to come in as well?
Yes, I also like to come in on this question of collaboration, because I think that that's really pivotal. And I just want to give one example of our work here on blue bonds. So, I mean, as some in the audience might know, I mean, blue bonds, they don't really have a guidance document like green bonds. So most blue bonds were issued under the green bond guidance by ICMA. So we actually, as ADB, we developed with IFC, with ICMA, with UNEP-FI and United Nations Global Compact a new guidance document for blue bonds just now in September. And we also reached out to private companies, to banks to comment on the draft that we had launched earlier last year. And so we worked on this. And now I think the important part now in the second phase of collaboration is actually now we work with the SEC here in the Philippines. So they just issued blue bond regulation now for the market here in the Philippines. I think that they actually, at least in Asia, the first country to issue such regulation. And tomorrow we will organize an event together with the SEC where we invited government, both Ministry of Finance as well as Ministry of Environment, but also companies and banks that want to issue blue bonds, as well as investors who are interested to invest into blue bonds, to come together and really share which nuts and bolts now have to be tightened in the right way, that all these actors can really come together and make this happen. And so I think that that's a really important part. And I think that's also something where an MDB can play an important role to offer this platform and the possibility to convene.
And I think there's a really good question there for Diana as well. Diana, what are the most critical policy or regulatory changes needed at the global level to facilitate the flow of both public and private finance in ESGs?
Thank you. I was going to give as example the reporting requirements in the European Union for corporates. In our reporting requirements, we have the so-called double materiality. So companies that are subject to reporting, they have to report not only on their own risks, financial risks caused by climate change, but they also have to report on the impact, the climate impact that they have on external climate impact that they have. This kind of reporting, together with the EU taxonomy, is a very strong incentive for companies to switch investment towards green. We know that it may not be enough. We have the European Union Sustainable Finance framework until now is based on transparency and reporting. So the combination of reporting requirements for corporates, for financial institutions, and the taxonomy. We know that probably there will have to be a next step, which is stronger in terms of incentive to switch investment from let's say the brown to the green. However, we also have the European Union ETS, the carbon pricing, which is already providing a very strong incentive to divest from emitting practices and invest towards green practices. So we think that this kind of instrument combined, and perhaps also combined in the future with further taxation instruments, which will make the incentives even clearer, should be one of the propelling forces for the alignment of the financial flows with the Paris Agreement objectives.
Thanks, Dana. And there's another question for Thomas. Tom, you said we shouldn't rely on MDBs only and focus on all parts of the financial system, but where do we start with others? A tiny, tiny question for you, Tom. And the system doesn't like you again. Sound. Nope. Yes?
Yes, perhaps.
You're good.
Okay. Yeah. Okay. So where do we start? Well, I mean, again, it's the title of your paper. It's everything, everywhere, all at once. We don't have time to kind of form a queue. We have to make sure that everybody is working out what their part is to play, which is why I was saying that we need to see transition plans from everybody. You know, how does the fact that all countries have signed up to Paris, all countries have signed up to come in Montreal, all countries have signed up to the SDGs impact the way that a central bank interprets its mandate, or a markets regulator thinks about how risk and the stability, integrity of markets, fair competition is spread throughout the system. If you're a finance actor, how does it impact the way that you are assessing where you're putting your clients' capital? If you're an insurer, who, let's face it, the trajectory we're on threatens the insurance business model in its entirety. You can't insure a 3-degree world. It just won't work. You have to think about, you've got this double vested interest. You've got to push like hell to change the trajectory, and you've got to work out how to change your underwriting practices. If you're a bank, you've got to think about your lending practices. If you're a real economy company, how are you going to get finance? You're going to need the best transition plan to get the best rates. So it's everything, everywhere, all at once.
So no British approach to orderly queuing in terms of delivery of private finance, but rather throwing the entirety and the kitchen sink at it. There's a
Exactly.
question.
You know, we've got big enough queues at COP, Nina. We don't need any more.
A question for Kevin. There's a good one about giving specific examples of sustainable business models and financial instruments you built based on local knowledge.
Yeah, I would say that Diana was highlighting a little bit about the green bonds, and what we have seen in the recent few years in Brazil is that also there is a lot of developments about the sustainable linked bonds, which it's good because in the end there is of course a commitment from the private sector in order to access at capital from the financial markets committed to do these kind of targets. I think that is one of the new realities, and of course it's another source of funding for those companies that need, of course, this kind of financial support in order to implement those solutions.
Wonderful, thank you. And all that remains for me to say is to say a huge thank you to all of our panelists, to Diana, to Tom, to Andreas, and to Kevin for being with us and discussing how do we figure out how to drive all of the private finance towards the climate nature nexus in emerging markets and developing economies. There is quite a longish paper that we've written about it, but also loads of really interesting comments from the panelists. So thank you very much. Thank you to the European Pavilion for hosting our virtual discussion today, and have a wonderful time, whether you're at COP or at home.